In the last few months, some of the biggest companies in the world have all blamed the same thing for laying off thousands of employees. Artificial intelligence, Microsoft, Salesforce, Monday.com. Their message sounds simple. AI is making workers more productive, so companies need fewer people. On paper, that's exactly what investors should want. Lower costs, higher profits, higher stock prices. But that's not what happened. Instead of rewarding these companies, the market did the opposite. On average, their stocks underperformed by nearly 10% in the month after those announcements. So here's the question. If AI layoffs are making businesses stronger, why is Wall Street selling instead of buying? Is the market seeing something everyone else has missed? Today, we're following the money to uncover what might really be hiding behind the AI layoff story. Let's start with what's actually happened. Over the past year, artificial intelligence has gone from being a futuristic technology to becoming the most common explanation for layoffs across the tech industry. Almost every week, another headline appears. A major company announces job cuts. Then, somewhere in the statement, comes a familiar explanation. Artificial intelligence is making the company more efficient. Microsoft was one of the biggest examples. The company announced roughly 4,800 layoffs, around 2% of its global workforce. While AI investment was accelerating across the business, many of the cuts landed inside its Xbox gaming division. That detail is important, because gaming isn't exactly where most people imagine AI replacing thousands of jobs overnight. It's not as if ChatGPT suddenly started designing video games, creating entire game worlds, or replacing every developer working on the next Halo title. Yet AI quickly became part of the public explanation. Then came Monday.com. The project management software company also pointed to AI-driven efficiency as one reason behind reducing parts of its workforce. Different company, different business model, different products, but somehow the same explanation. And they weren't alone. According to reporting tracked by the Financial Times, more than 20 companies referenced AI as a factor behind layoffs during the year. Think about that for a moment. More than 20 separate companies, different industries, different executives, different financial situations. Yet they all seem to arrive at almost the exact same headline. AI is making us more efficient. When the same explanation starts appearing over and over again, it's worth asking whether we're looking at a genuine technological revolution or whether we're witnessing the birth of a powerful corporate narrative. On the surface, the story sounds perfectly logical. If AI allows one employee to complete the work that previously required two people, then the company needs fewer employees, fewer salaries, lower operating costs, higher profit margins. That's basic business economics. And historically, investors have loved efficiency. Whenever companies find a way to produce the same results while spending less money, Wall Street usually rewards them. Lower costs often translate into higher earnings. Higher earnings often translate into higher stock prices. At least, that's how the story is supposed to work. So if AI is genuinely making businesses leaner, faster, and more profitable, there should be one obvious result. Investors should be celebrating these announcements. The stocks of these companies should be rising, because that's exactly what markets normally reward. But that's where this story takes an unexpected turn. Because when we look at what actually happened after these announcements, the numbers tell a very different story. But that's not what happened. Instead of rewarding these companies for becoming more efficient, the market responded in a way that surprised almost everyone. And this is where the story becomes much more interesting. The Financial Times looked at companies that publicly linked layoffs to AI and compared their stock performance with the Nasdaq over the 30 trading days that followed those announcements. The expectation was simple. If investors truly believe these layoffs would create stronger, leaner, and more profitable businesses, their share prices should have outperformed the market. Instead, the opposite happened. On average, those companies underperformed the Nasdaq by nearly 10%. Read that again. Not one company, not one bad earnings report. An entire group of companies telling investors that AI was making them more efficient. And the market, on average, responded with disappointment instead of confidence. That's a remarkable disconnect. Because stock markets don't react to headlines. They react to expectations. Every day, millions of investors around the world try to answer one simple question. Will this company be worth more tomorrow than it is today? If the answer is yes, they buy. If the answer is no, they sell. So when investors consistently sell after hearing about AI-driven layoffs, it suggests they may be seeing something beneath the surface. The obvious question is, what exactly are they seeing? There isn't one single answer, but there are several theories, and together they paint a much more complicated picture than the headlines suggest. The first theory is that investors simply don't believe the AI explanation. They suspect AI is being used as a convenient way to explain layoffs that were already going to happen because of slowing demand, weaker growth, or pressure to cut costs. After all, saying, "We're transforming with AI," sounds far more optimistic than saying, "Our business isn't growing as fast as we expected." The second theory is more subtle. Even if AI really is improving productivity, investors may worry about what these layoffs reveal about the business itself. If a company suddenly needs to eliminate thousands of jobs to protect its margins, perhaps the underlying business wasn't as healthy as it appeared. Efficiency is valuable, but efficiency achieved under pressure tells a very different story than efficiency achieved from a position of strength. And then there's the third theory, perhaps the most unsettling one. What if investors are no longer asking whether AI makes a company more efficient? What if they're asking whether AI is changing entire industries faster than companies can adapt? Because if technology begins reshaping the workforce faster than businesses can reshape their revenue models, efficiency alone won't solve the problem. Now let's step away from the stock charts for a moment and look at something even more important: incentives. Because once you understand the incentives, the headlines begin to make a lot more sense. Imagine you're the CEO of a large technology company. Business has slowed. Revenue growth isn't as strong as investors expected. Costs have climbed after years of aggressive hiring. And now you've reached a difficult decision. Thousands of jobs have to go. Soon, you'll stand in front of investors, employees, and the media to explain why. So, how do you tell that story? Option 1 is complete honesty. You say, "We expanded too quickly. We misjudged demand. We hired more people than we needed, and now we're correcting those mistakes." It's honest, but it also sounds defensive. It tells investors that management made poor decisions. It raises uncomfortable questions. What else did leadership get wrong? Can they be trusted to avoid making the same mistake again? Now consider the second option. You announce that your company is embracing artificial intelligence. You explain that new AI tools are making employees more productive. You describe the layoffs as part of a long-term transformation designed to build a faster, leaner, and more innovative business. Notice the difference. The layoffs are exactly the same. The number of employees leaving hasn't changed. The financial impact hasn't changed. Only the story has changed. Instead of looking like a company fixing yesterday's mistakes, you look like a company preparing for tomorrow's opportunities. And that's why AI has become such a powerful narrative. It transforms a painful decision into what sounds like a strategic decision. It shifts the conversation away from weakness and toward innovation. Now, this doesn't automatically mean companies are being dishonest. AI is absolutely changing the way many businesses operate. Routine tasks are becoming automated. Software developers are writing code faster with AI assistance. Customer support teams are using AI to handle common requests. Marketing departments are creating content more efficiently. Real productivity gains are happening. The important question isn't whether AI is real. It clearly is. The real question is whether AI is responsible for every layoff that's being linked to it. And that's much harder to prove, because there's no public report that tells investors exactly how many jobs disappeared because AI replaced them, and how many disappeared because the company simply wanted to reduce costs. Those two situations can look almost identical from the outside. That's why investors don't just listen to press releases. They compare the story with the numbers. They examine revenue growth, profit margins, future guidance, hiring trends, capital spending. So, what does all of this actually mean for you? Because this story isn't just about CEOs or Silicon Valley. The way companies talk about artificial intelligence is already influencing decisions that affect investors, employees, and the economy. If you're an investor, don't stop at the headline. A company announcing AI-driven layoffs doesn't automatically mean it's becoming a stronger business. Ask a simple question. Do the financial results actually support the story? Is revenue growing? Are profit margins improving? Or is AI simply being used to explain cost cutting? Because the market seems to be sending a clear message. Investors aren't rewarding the narrative, they're rewarding the numbers. Now think about employees. AI is already making many jobs more productive by automating repetitive tasks. But not every layoff linked to AI means a machine directly replaced a person. Sometimes the real reason is slower business growth. Sometimes it's years of overhiring finally catching up with a company. And sometimes it's both. That's why understanding the difference matters. If technology is changing your role, adapting your skills is the answer. But if the problem is a weaker business, that's a completely different challenge. So where do we go from here? The answer won't come from headlines. It will come from results. If AI is truly creating stronger businesses, we'll eventually see healthier profits, stronger earnings, and sustainable growth. If not, investors will continue questioning every AI layoff announcement. And that's the biggest lesson from this investigation. Whenever a company offers a simple explanation for a complicated decision, pause for a moment. Look beyond the headline. Study the numbers. Watch how the market reacts. And most importantly, follow the money. Because in business, the story people tell and the story the numbers tell are not always the same. If you enjoyed this case study, subscribe and turn on notifications so you don't miss the next investigation. And let me know in the comments, do you think AI is really replacing jobs? Or is it becoming the perfect cover story for layoffs? I'll see you in the next case file.